Great, welcome back to the last session of the IAS 8. That is the accounting policy, changes in accounting estimates, and then the errors. Good. Now we were solving or trying our hands on some 3 to 4 illustrations. So let's continue. But I'll start all over again. So the first one states that, okay, so this example. But which of the following is a change in accounting policy as opposed to a change in estimate technique or in an estimation technique? One, an entity has previously charged interest incurred in connection with the construction of the tangible non-current asset to the statement of profit and loss following the revision of IAS 23 and in accordance with the revised requirements of the standards. Of that standard, it's now capitalized this interest. So, so this does it amount to a change in accounting policy or it amounts to a change in accounting estimate or it's an error? Yes. In fact, this is a policy because they've changed the recognition and presentation of the item. Good. And this change is permitted by what? By a standard. So it has been justifiable. It has been justified. It has been justified. That's great. Two, an entity has previously depreciated by acquisition reducing balance method at 40%. It now uses the straight line method over a period of 5 years. So is it a change in accounting policy, estimate, or it's an error? This is what a change in accounting estimate because depreciation, estimating the depreciation value is not a policy, it's an estimate. Good. Now, an entity has previously shown a certain overhead within cost of sales. It now shows those overheads within administrative expenses. Now you're moving from cost of sales down to operating expenses. So it's what change in accounting policy because they have changed what accounting. That's the presentation. Yeah. So the presentation method has been changed. So that's the accounting policy. And then lastly, an entity has previously measured the inventory at weighted average cost. It's now measured the inventory using what? First in, first out. That's the FIFO method. That is a change in accounting policy because we change what? The valuation or the measurement. Valuation or the measurement of the inventory. That's great. Now let's quickly look at the prior period errors and then you are fine. The prior period errors and then that is the end of the game. Now the errors. What is the treatment? What is the counting treatment for correction of the errors? Good. Now what are errors? Errors are omissions. So prior period errors are omissions or misstatements from the entity's financial statements for one or more prior periods arising from failure to use or misuse a reliable information. In fact, error is what? An unintentional mistake. Good. So intention ones, that one is what? Fraud. And all of them are inclusive. Yes, they are inclusive. They are being captured in the IAS 8. So basically, that is it. Now we know. We know what an the errors, the actual meaning of them. But this one, it comprises the intentional and an unintentional. Yes, it includes all omissions, misstatements in the entity's financial statement. That is what error. So prior to the financial statement, um, you know, sometimes the error occurred last year will be probably discovered in 2 years' time or maybe today. So that's what we call prior period errors. So we've already prepared a financial statement and then published it out, presented it, but there was a mistake or there's an issue, there's omission or misstatement. Meanwhile, this misstatement, we just realize it in today's financial statement or the current year when you're preparing the current year financial statement. So what do we do? So that is it. Now, what are the examples of the prior period error? So anywhere, anytime you see this in exam question, the amount what they are prior period errors. Now, one, effect of mathematical mistakes. So mistakes in applying accounting policy. The mathematical mistake is the items instead of when you casting like sales is 20,000 and then the cost of sales is 18,000, so the gross profit must be 2,000 and you realize you wrote 4,000. This is a mathematical mistake. Accuracy, good. This is this mistake has nothing to do with accounting policy or estimate, no. Then the second one is the mistakes in applying the accounting policy. Mistakes in applying what? Accounting policy. Good. So it's like the remix. Yes, you have misused the accounting policy. The accounting policy states specifically that it must be treated as an asset, but you are recording it as what? As an expense. So that's an error there. Then oversight or misinterpretation of facts. And finally, fraud, intentional mistake. Yes, that's a fraud. So now let's go straight and look at the accounting treatments of the errors, or we call it the correction of prior period what errors. So we have to correct it. Now here, you have to do what you call retrospective restatement. Retrospective. So here you have to correct the error as if the error has never occurred. So we go to, so here to, because we are going to apply or we are going to um, correct the error as if it has never been occurred, which is the retrospective restatement, then we have to bring the open balance of the retained earnings and then adjust it or correct it with the effects of the error. So that's the issue. Now it means that once we are applying retrospective restatement, then comparative information must be what? Restated. Comparative information must be restated. So that is it. So the open balance of the retained earnings and then the asset and liability must be adjusted as if the errors has never occurred. Had never occurred. So that is it. Now the second point is the comparative information. We've explained that under the accounting policy. Good. Now that is the end of the IAS 8. In fact, I have provided a table here that summarizes everything. So I will discuss the table again. In fact, in the table, it summarizes all like everything about the IAS what 8. First, it talks about change in accounting policy, the accounting treatment, what happened in the profit and loss, and what happened in the changes in equity, which is the statement of the financial position. But whatever happened, the changes in equity, the final result will be carried to the financial position. So it deems as the financial position. Good. So when there's a change in accounting policy, we said that it must be treated or accounted for in the previous years, or the change must be applied retrospectively. So that is retrospective application, as if the change has always been there. Has always been there. The change, but as if the change has not has always been there. So let's make the share see if the change has always been there. Good, the change has always been there. Good. Okay, so that's green. Now in the profit and loss, in fact, here too, that's the first treatment. You know that there was a section. If it is impracticable to apply the change, then what do? If it's impracticable to apply the change retrospectively, then prospective application will be applied or must be applied. That's good. So profit and loss, what do? In a period of the change, if the change affects that period only, then the period of the change and the future period if the change affects both. That is it. The statement of changes in equity, what do? Adjust the opening balance of the retained earnings and the statement of the change in equity, and then the comparative information should be provided. And this will not be the same as the change in accounting estimate. For change in accounting estimate, that's prospective all the way. And then in the period of the change affects that period only. And then the period of the change in future periods if affected was both. And what about what goes to the changes in equity? Apply the new change. So you apply the new change. So here we don't adjust the opening balance of the retained earnings, and no entry is made in the changes in equity or statement of the financial position. Good. And then the prior period errors, it also follows the same way to that of the or the same procedure to that of the change in accounting policy. So that one to retrospective restatement, as if the error has never occurred. So that is it. Great. Now correct the with the correction, correct the period in which the error affects, and the restating the opening balance of the assets and liabilities and equity. Comparative information should be provided. So that is it. Good. That's great. So now let's look at this and then you'll be fine. So now this is the illustration. So starting with the question solving stage, we will go to the illustration. So kindly be with us when we are solving the questions. So for those of you who have gone through the illustrations and you are okay, Then can you try this one for me? The tutorial questions. So tutorial questions, they are very good for your health. And then you'll be fine. Kindly subscribe to the channel if you have not done that, so that any upload you will get a notification. Any upload you get a notification, and then you'll be fine. So these tutorial questions are very good for your health, especially. Question 3. But question 4 is your past question. That's November 2000 and what 18 code. So we will try that one too. November 2018. Then we are done. Our next standards will be the event after reporting period. And then look at that one too. We look at that one too. So thank you very much for um, watching the video, and then thank you very much for subscribing. You can tell a friend to tell a friend and share the link with your friends, family, and your loved ones. Yes, even if they are not doing what I see. Then we also prepare and then financial statements. In fact, we run the financial consulting services, being advisory, bookkeeping, account preparation, tax planning, then the tutorials, journal printing. So, in fact, it's a whole group of business in the companies. So, get close to us and then get more from us. So, get close and get more. So, that is it. So, kindly stay tuned for the question solving stage and be with us. You can join us when we are solving the question together. That's where you bring your challenges. Any issue you have with the video or the lectures or the explanation, you will do more there. So thank you very much once again. Good, 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 goodbye, everyone.